You're ready to purchase your first life insurance product, and the question arises, do you buy from a mutual company or a stock company?
You are listening to Wealth Talks. Today you're going to get to hear the difference about stock-held versus mutually held companies. What is the difference? Are there really any mutual companies left out there today?
That's a good question because, reorganization has changed a lot of what we thought was mutual companies into mutual holding companies. And of course, then stock companies are always been out there that are selling stock to stockholders, taking some of the profits maybe away from policyholders, but at the same time, raising capital for the company.
Yeah, so that's the benefit of a stock-held company from the insurance company's perspective is they can raise capital by selling more stock to investors. So it gives them some flexibility also in the way that they manage things, but they have an accountability to the stockholders. They've got to show them consistent profits because that's what stockholders are looking to see.
That's exactly right. And so, it may be that you could buy a very inexpensive term product from a stock-held company because they are deriving capital from other sources besides premium and premium investments.
There we go. So stock-held companies on one hand. Now let's talk about mutual companies. Mutual companies traditionally, that's how a lot of insurance companies have operated or started operating, is they formed a mutual company where the policyholders were actually part owners in the company, and they get to share in the profits of the company just like stockholders share in the dividends. Only with mutual policyholders, that's counted as a return of premium under the IRS code so that you don't actually have to pay taxes on it as soon as you receive it if that's building the policy value that you have.
That's correct. And unlike stock, you can't really just trade your stock to someone else or sell it to someone else. You'd actually have to sell your policy to someone else, and it would be an asset exchange at that point so that someone else would become the owner of your policy, but you would remain the insured, which, can be uncomfortable to some people.
Yeah. So today, modern day, if you're looking at your life insurance policy contract, as you read through it, even if you are with a quote mutual company, you may read through the contract and see that the company your policy is issued from was issued by a stock company. What does that mean?
Well, that's called structuring.
Yes.
And the way a company is structured is really important because let's say that I get a policy from Company X.
Okay.
But Company X is actually owned by Company Y,
okay,
who is really owned by Company A.
So at the very top, we have Company A, and then we have an intermediary company in the middle that's called Company Y here. And then at the very bottom, you have Company X, which actually issued the policy. Is that what you're saying?
That's correct.
Okay. So we have three different companies here. This is called, the Company A would be a mutual holding company.
It would be a mutual holding company, and you as a policy owner would have a voting right to control who the board is, maybe the CEO and things like that.
And that's where your dividends would be based on, as the profits of Company A.
However, Company Y, their stock has to be controlled by Company A.
So Company A has to own the majority of the stock of Company Y.
That's correct. Okay. But Company Y can sell stock to other individuals or entities. They can actually trade.
So they can actually sell their stock, and people can buy that. That's a way for them to raise capital.
That's a way to raise. So, and then, of course, under Company Y is Company X that actually issues the policy.
So when you're reading your life insurance contract, as you're reading through, you may see that Company X is a stock-held company. But if it's owned by Company Y and you have the mutual, the rights of the mutual policyholder through Company A, then overall it's really the same net effect for you.
That's correct. And the fact that there is that intermittent Company Y allows mutual companies then to compete with stock-held companies on the cost of insurance because they can raise capital just like a stock company can.
Very good. These other companies also allow the structure allows them to buy other types of companies. Stock-held companies are even international companies that they can buy and manage under the same umbrella, but they're actually these different businesses that they're all combining here, which can help us as mutual policy owners if we're getting profits from some of that.
So it's important that we understand all this terminology to the point that, yes, it's still important that you have some type of mutuality in your policy. Otherwise, your dividends could be non-existent to null. However, at the same time, just because a company is not a mutual company, but rather a mutual holding company, doesn't mean that that makes that company any less desirable.
Yeah. In fact, most of the mutual companies that you'll see left over today are organized as mutual holding companies in some way, shape, or form.
And that's because we are in a very competitive market, and we have to be able to allow the premiums that we pay to the insurance company in some shape or way be competitive. Mm-hmm. And we have to, and at the same time, there's a restriction on that so that they're not putting you at risk, because 50% of that intermediate company is controlled by the mutual holding company.
Yes, and that brings up another point. One of the reasons they're structuring this way is to protect themselves against risk, because adding these additional layers allows them to manage everything under the same umbrella, but it also separates some of their different businesses so that life insurance policy owners, for example, don't have to be liable for the effects of maybe what's happening over in the retirement investment business that they have as well. So it segregates their risk a little bit more and allows them to manage that better.
And like you said, a lot of companies are moving to this so that they can buy like payroll services in South America, or investment firms in China, or they can divest all over the world, because we really are a global economy, and we need to have some ability to have a footprint in that economy. Otherwise, we won't be as competitive. There we go.
So a question came in from one of you the other day talking about the 7-pay test. The 7-pay test, if you're not familiar with it, is a term that surrounds the concept of the modified endowment contract. And this comes from a couple laws that were passed in the late 20th century that define how life insurance can be designed, how much death benefit there and cash value there can be compared to the premium that has been paid.
And in a rough definition, the 7-pay period means that you cannot put more premium into a policy than what it would take to pay it off or pay it up in 7 years. And if you do that, it will become a modified endowment contract. So this has some effects on the way a policy can be designed. Prior to these laws that were passed in the mid-'80s, you could put a large chunk of money into a life insurance policy called a single premium policy, and you could immediately borrow 95% of that money while you had a death benefit as well, without running into any tax liabilities for doing that.
So that's a really good thing, and a lot of people were doing that instead of putting their money in the bank. And the banks weren't very happy about that. And so they got involved and got Congress to pass the laws about the 7-pay test here.
Now, that doesn't mean that you have to put all that money in the first 7 years. But if you can get as much money in that policy in the first 7 years, not violating the 7-pay period, then that means that the paid-up insurance in the policy is going to be compounding more quickly for you, and there will be more cash value, and ultimately there could be more death benefit down the road because of that.
Okay, so how does it work when you see a policy being funded and the premium stays the same for a number of years? You really don't see anything happening around year 7.
Well, that's because there's less money going into the paid-up part of the policy. The single premium part is reduced when you're putting a large payment in for a long period of time. It's reduced not to violate the 7-pay period. Whereas if you reduce the the premium later on in the policy, then you're able to get more of that money up front where it's going to compound for you quicker.
Okay. So some people will take, since the 7 pay period here is a definition of how much premium to cash value and death benefit that you can have, some people will put a term rider when they design a policy. They'll add a term rider on to artificially boost the death benefit so they can get even more money in, compounding faster. Why is that not such a great idea?
Well, it depends on what you want to accomplish. I tell people, if you are just trying to create a savings account with a life insurance policy, and you never intend to really borrow from it and leverage it and use it for other opportunities like, Jeff Bezos and Warren Buffett and those people manage other people's money and make more money, then putting a term rider on a policy is not really necessarily a bad thing because it will allow you to get more compound growth earlier in the policy. Mm-hmm. However, it also costs you to put that term rider on there.
Yes.
And it limits then when you can drop that term policy or rider off without causing the original whole life policy to become a modified endowment contract, because let's say you artificially raise the death benefit for the first 3 years and then you didn't want to pay for the term rider after that. Well, now automatically that policy is going to become in violation of the 7 pay period. Mm-hmm. And it's going to become a modified endowment contract. And now, if you're not 59 and a half and you need to access the money, you're going to pay a 10% penalty to get it, and you're going to pay taxes on it. And if you are after 59 and a half, you're still going to be paying taxes on a loan.
Yeah. So this is kind of serious here, and we're throwing out a lot of terminology if you haven't been listening to this podcast before. So real quick, as an overview here, modified endowment contract is what is defined as making a life insurance policy similar to a qualified plan. They basically give you a 10% penalty before the 59 and a half, like you said, and you would have to pay taxes on all the growth when you access that money. Last in, first out, instead of first in, first out like most life insurance is. So that's the MEC, and the 7 pay test that we were talking about helps define what that MEC, what type of life insurance policy does become a MEC contract.
So the 7 pay period can also be violated by someone borrowing from their policy and paying back more interest than what is being charged by the insurance company.
Sure.
Because everything over what the insurance company is charging, when that loan is fully paid off, will be considered extra premium. Mm-hmm. And if that policy was already written at the limits of the 7 pay period, then that extra interest or payment is going to make that policy a modified endowment contract.
Yeah.
And so that's something that is necessary. Now let's go back to your original question. Why may that not be a good idea? Well, if I'm having to put wanting to put more money into a policy just to borrow it back out again, now I may have not done anybody a service by doing that. First of all, if I'm going to use the money, why did I want to put it in life insurance first before I borrowed it back out? Because now I am going to face an interest charge. Mm-hmm. So if you have an opportunity to create more money with your money without buying a life insurance policy from it, it's always a good idea to make that money first. Now, it has to be really sure and certain, mm-hmm. because you are giving up the guarantee of a life insurance contract where you will get a guaranteed return on it. But let's say that you could make 10% on $100,000 instead of putting $100,000 in a policy and only maybe getting about 70% back out to make an investment. Well, it makes sense to go ahead and make the investment if you know you're going to make 10%. Mm-hmm. Because now from the proceeds of that investment, you can buy your life insurance.
Sure. And maybe it makes sense to take a part of the $100,000 and buy some life insurance and then go do your investment. You know, there's a balance here, because some people will take this and go to the other extreme with it, and they'll say, I have debt. Maybe I should get out of debt and wait 3 to 5 years to start a policy rather than starting it now.
Well, that goes back to the fundamental rules that you have to protect first, save second, consolidate debt third, and then invest last.
There we go.
And the world flips those up, and they want to invest first, save if they can, then, well, if they have any debt from their investment, they'll probably want to take care of that first and then save, and then try to protect what they have. So even though you may not buy a participating whole life insurance policy, you need to have the protection in the form of a convertible term at least, so that when that investment does start producing for you, you have some place to save. Mm-hmm. And then the life insurance can become the receptacle of those returns, so that the next time there's an opportunity that comes along, you don't have to lose the interest or the growth on your savings while you make the investment.
There we go. And that's because there's a time element involved here. So if you're going to have a policy loan out for a couple of years while you pay off debt, and then it's going to get paid back pretty quick with the cash flow that was going to that debt, great. Go ahead and do that. Now you haven't killed the compounding that would have been killed if you waited 2 years, 3 years, 5 years. Some people wait a lifetime, and it doesn't get any better. It gets worse.
This brings up the concept that we talk about in Winning Your Financial Game called thinking both. Wealthy people never think about making an investment and losing the money on the investment. They always think, how can I make the return on this investment and keep control of my money? They always think about, how can I buy the second house and keep the money that it cost me to buy the second house? They think about, how can I make this donation and keep the money that I made the donation with?
Yes.
And that's where life insurance becomes so important. We were just talking with a CPA the other day that talks about charitable remainder trust and how he helps people set up the life insurance part of that, so that the next generation doesn't lose out on the money that the first generation made, but the first generation gets a huge tax deduction because they give all their money away. And we see this happening with Bill Gates and Warren Buffett, and Jeff Bezos' wife that just got divorced. They're all doing this. They're giving away all they have, but they're not really losing the control of the money. And the next generation is going to get it all back tax-free too. So that's one of the ways that wealthy people think. And we have to think that way too. With your, going back to the $100,000 example we were just giving, if you buy life insurance with it first, then you may not have the opportunity to get that 10% return. But if you don't get some type of coverage at the same time, you've set yourself up for a huge loss if that investment doesn't come around like you thought it was.
Yes. So you always have to start with a foundation of guarantees at some level. And where does that foundation of guarantees start? It kind of goes back to the 10-20-70 rule that you may have heard us talk about. 10% of everything you make is yours to keep. Savings. 20% is the maximum to creditors. If you don't have any debts, then you can be saving up to 30%. And 70% of your income then should be the maximum that goes to your lifestyle expenses.
And of course, we use savings here loosely because savings and keeping money are two different things. Savings implies hoarding it, and keeping it actually means that you are nurturing it, managing it, and making it grow.
Yes. I love the example that you share about somebody keeping their pet, their dog or their cat, rather than saving it.
Yeah, it's impossible to save something that is spiritual. It's something that has to be, you can't save it. You've got to keep it. You've got to nurture it, and it has to continue to grow, or its value is lost.
Yes.
And of course, that goes back to Rabbi Lapin, who talks about that money is a spiritual phenomenon because it's something that animals don't do. And anything that animals don't do that humans do is a spiritual phenomena.
Spiritual phenomena. That's right. So money is spiritual. The way that you manage your money should be spiritual as well. You should keep it, not save it. Don't hoard it. Otherwise, it'll come back to bite you in some way, shape, or form.
So we've talked a little bit today about the way life insurance companies structure themselves and why that could be to your advantage and how it could be to your disadvantage. We've talked about how policies are structured or designed, how that could be to your advantage or disadvantage. And the one thing we haven't talked about is when would a single premium or a MEC policy be a good idea, John?
Yeah, that's a good thought, because with the MEC rules, very similar to the qualified plan rules, there's a window of time where there isn't any penalty for having one of those policies. That window of time is generally going to be between age 59 and a half and age 70 for somebody with a qualified plan, but we don't have the upper limit of age 70 with a life insurance contract. There's just the 59 and a half. So, for example, somebody that's already over 59 and a half or pretty close there, if they have a lump sum of money that they want to plunk down and buy life insurance, get the compounding growth, and they don't plan to access it very often, it is there if they need to. They don't mind paying the tax on the growth if and when they do access it. That could be a case where a single premium policy could work very well.
Yeah, let's take, for example, someone that has been very actively involved in managing their money all their life and is just winding down and doesn't want to put that much effort into it anymore.
Sure.
But they want the contractual guarantees that they won't lose what they've gained. And they would like to be able to multiply what they have to pass on to the next generation without taxes. And now that's a single premium policy. It gives you more control over your money than an annuity would. And it can grow at approximately about the same rate as most annuities are growing right now.
Sure.
And so the only thing that you would have to realize is that if you accessed your money, the growth has to come out first. And on the growth, you will be taxed, just like if it was earned income. But the principal that you put into that policy to purchase it will never be taxed.
There we go.
And so this gives someone some liquidity that there might be an opportunity that comes up that they just can't afford not to take advantage of. And so they still have liquidity, whereas if that money was tied up in an annuity, they wouldn't be afforded that without facing a penalty.
Yes. And if the death benefit goes to the heirs, the next generation, then that goes income tax free.
That's correct.
No tax on that growth, just like a regular life insurance policy. So if you never plan to access it, definitely an option, and it still lets you keep control of your money. So and really, if you haven't got it yet, we're all about keeping your options on the table as long as possible. You want to keep your options on the table because you don't know which ones you're going to need yet, and you probably won't till you get there.
And naturally, the sooner that someone starts funding a life insurance policy, the less it will cost you to have the security and sustainability that it can build into your life. That doesn't mean that you should not look at life insurance in your 50s and 60s, because that is the time when most people are generating most of the income that they'll make for their entire life. And if we don't get some of that money for you in a place where you have access to it and control over it without facing on taxation, then your golden years could be a little bit more stressful than what you would care to cover. So it's important that you reach those golden years with a balance of money that you have kept that is in your control, so that those years are spent as pleasantly as possible and you don't run the risk of running out of money.
There we go. Yeah, never fun to run out of money. They say that's the number one fear in America today, is people are afraid of running out of money when they retire, but before they die. You don't want that to happen, so make sure you get the guaranteed foundation that can keep that from happening, so you have the security and the sustainability that you deserve. Until next week, we'll be back here on Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life.